What's up, guys, and welcome back to another episode. Today I'm going to be talking about the Federal Reserve cutting interest rates by 25 basis points for the third time this year. And this time, Jerome Powell did not crash the market by saying that there's not going to be another interest rate cut in the next up-and-coming meeting. I'm going to dive into this rate cut and how the Feds are going to rebuild the economy, what it means for the stock market, the bond market, and how you guys should invest your money. So let's jump right into it. Once again, if you have not already, definitely make sure to go check out my Discord. It's completely free, linked down below, offers a lot of tools and insight into the stock market, the economy, and the bond market. If you guys had already joined, you would have gotten all of the notes following Jerome Powell's press conference the other day. There's a lot more like that, so definitely make sure to go check it out. So diving into the rate cut, Federal Reserve cut interest rates by 25 basis points yet again. It's sitting at 3.75% for the federal funds rate. One of the most important notes that Jerome Powell stated in the press conference was on inflation. A lot of consumers are complaining about the rising cost and inflation, and that is a concerning factor about the economy right now. Jerome Powell said that this inflation is primarily on goods and not services, and it's all due to tariffs, and this is just a one-time price increase. This is the first time the Federal Reserve actually did monetary policy and used the job data instead of the inflation data, something that the Federal Reserve has not done. But Jerome Powell said this is a one-time price increase, so it's more important to focus on the job data rather than the inflation data, and the economy still seems pretty strong. He stated that inflation could peak in Q1 of 2026 and then start to come down to a more reasonable level in the back end of 2026. That is if President Trump does not enact any more tariffs, which we are not sure if he will. Importers are now getting hit by tariffs very strong. It takes 1 to 3 months till importers actually really see the effects of the tariffs, and the prices are increasing. Companies are now having to increase their price to combat this rising expense. So a lot of pressure is on the consumer now as companies are increasing their prices of the goods. It is important to note that the job market is somewhat weakening. It still holds pretty strong, but in the eyes of the Federal Reserve, they think that they need to enact this interest rate cut to combat this problem. All the numbers look somewhat decent and nothing crazy, although unemployment is starting to slowly rise, so this interest rate could help that number come down. This time, though, Jerome Powell did not state whether or not we are going to see an interest rate cut going into the first meeting of 2026. He did make it very clear that the Federal Reserve is enacting this monetary policy to try to rebuild or reset the economy, and that is their main concern right now, primarily focusing on the job market like I explained, while also trying to combat this inflation problem. So how does this affect the bond market? Everything else equal, when interest rates come down, bond prices go up. It holds an inverse relationship. So now newly issued bonds are offering lower yields compared to already issued bonds. That's because now the interest rate is lower, so these newly issued bonds offer a lower coupon rate than the already issued bonds, which now have a higher coupon rate. So demand increases for these already issued bonds, and the price then goes up. Since October, though, the U.S. government 10-year Treasury yield has actually been rising. The bond market looks pretty strong right now, and this is telling us that bond investors aren't too scared about the rate cut and how it will affect the bond market, as well as they have some optimism in the strength of the economy. Now, in terms of the stock market, the future is hard to predict. But we've seen from historical trends that when interest rates go down, the stock market usually floods with more money. This is another factor that an interest rate cut actually does kind of justify valuation in some type of way. Now, the equity market right now does hold a very high valuation, and Jerome Powell even stated so. But an interest rate cut makes companies more profitable and their earnings increase, which justifies this high price to earnings ratio that a lot of companies are seeing right now. Right now, the forward PE ratio of the S&P 500 is sitting at 23.19 times earnings. The 30-year average is 17.1 times earnings. So if we're looking at that ratio, the market is somewhat overvalued. But the forward PE looks at estimated earnings per share in the future, and this interest rate cut could actually benefit companies going into the first quarter of earnings in 2026, completely justifying this whole high valuation that the market is seeing right now. I think that the market will finish off somewhat bullish by the end of the year. Interest rates allow investors to invest more money into the stock market, like I said, and I think we may be able to see this Santa Claus rally that all investors are wishing. All right, so how should you guys invest your money? Well, like I always say on this channel, definitely invest in the broad market indexes, and you can target ETFs, such as the Vanguard Total Stock Market ETF. This provides exposure to more than 3,500 different companies in the market, allowing for a diversified ETF that provides you with good growth while still providing you with low risk. Or the SPY, or the SPY, that tracks the S&P 500, is also a very safe bet. And continue to dollar cost average, no matter what happens to the market. When you dollar cost average when the market is going down, that's when you see the best returns in your dollar cost averaging strategy. This has shown to be tremendously profitable over the long run and will give you very considerable returns if you continue to do this over the period of 10 to 30 years, depending. Another thing you can try to do, although it may be more risky if you don't know the information on it, is try to target already issued bonds. Like I said, they have a higher coupon right now. The price is going up, so try to find already issued bonds that are at a discount. They're under par, so you invest in them, say at $98, and then they mature at $100. So you're making $2 profit as well as the interest that you make from their coupon rate. It is important to note that you need to take in your tax situation, your time horizon, and many more factors. So this interest rate cut is going to help the economy. It's going to help businesses, in the stock market will do very well from this. I don't know if we're going to see another interest rate cut going into the first meeting of 2026, although if we do, I think that it will yet again help the stock market. Like Jerome Powell said, this inflation is a one-time price increase. That is if President Trump does not enact any more tariffs. So really only time will tell on that. So that's all I got for you guys in this episode. I hope you enjoyed the episode. Make sure to subscribe, like, check out my Discord once again, and I'll catch you in the next episode.